how could you save $213,000 in taxes? Welcome back to our tax series here. I'm Nate Miller, and today we're going to be going over an example of how you could pay way more tax than you could if you actually had good tax planning. We're going to go through a specific situation to where we're going to show you how you can save $213,000 over the life of your retirement. Now, stay tuned at the end for a tax tip that most people that are retired completely forget about, right? So the IRS can tax your money from your IRA several different ways. And so here are 3 times under current law where you can tax money from your where they can tax your money from your tax deferred accounts. Okay. When you take it out, you can be taxed on it. If you reinvest it into after-tax accounts, you can be taxed on it. And when you die, unfortunately, Uncle Sam is not done with this yet. They can tax your kids still too. So we're going to go through this. So bear with me here. I'm going to go ahead and share my screen. You're going to see a specific example here. Okay, so you should be seeing a PowerPoint right now. And first, let's go through a few of the assumptions that come along with this. So this is going to be a 66-year-old. So someone who might be in the height of their retirement, right? And let's say they're in the 25% tax bracket. The old adage of you're going to be in a lower tax bracket when you retire. What we are finding is that is actually not the case. Most of the retirees that I work with are in the same, if not higher tax bracket, if they've done a really good job saving. And also if they're lucky enough to have a pension, they could find themselves in that situation pretty easily. Now, his IRA is going to be worth $500,000, and we're going to assume a very conservative growth rate of about 5%. Now, the only thing he is going to do is he is going to withdraw these for his required minimum distributions. And in this example, he doesn't need those. I run into a lot of people that they're just reinvesting the required minimum distributions. They made all this money, they saved, they were really diligent, and at some point they don't even need it anymore. And so it's not used for income. It's going to be reallocated to other financial vehicles after tax accounts, right? And we're going to figure that those are growing at a conservative 5% annually as well. We're also going to assume that this tax holder lives to age 90. So here's how this works, guys. So this is going to compare one scenario versus another scenario and how much taxes that you will pay over the life of your retirement based on which one you decide to do. Okay, so the first one here is going to be, let's just say his total taxes paid on the growth of, RMDs at withdrawal. So he's only taken his RMDs every single year, and that is going to be roughly $158,235 in taxes that he's going to pay on all those required minimum distributions throughout his entire his entire retirement. Now, remember, he doesn't need the income, so he's going to reinvest those into taxable accounts. Now, remember, you're not taxed on the basis, so you'll never be taxed on what goes into those accounts. You're only taxed on the growth. The problem is you're taxed on the growth of those dividends and stuff like that, mutual funds, if you have phantom growth, whether you take them out or not. So the taxes he's going to pay on those, almost another $70,000. Now, when he passes away, there's still a balance that's going to be left, and that's going to go on to his beneficiaries. And now the taxes paid by the heirs on the remaining IRA value at death are going to be $110,294. Again, assuming the 25% tax bracket. So the total taxes paid in this scenario, $338,505. That's a lot on a balance that when he was 66 was only $500,000. $500,000 balance at age 66, and he ends up paying $338,000 in taxes by the time he's 90. All right, that is a lot of taxes. So let's look at a different scenario. What if he decided to do some Roth conversions? Well, same $500,000 that he's going to convert. Now, we're probably not going to do this all in 1 year because that would bump him up a few tax brackets. But let's say we did this strategically over 3, 4, 5 years, right? Taxes paid on those Roth conversions, $125,000. Again, assuming they're in the 25% combined tax bracket. How much tax do you pay on the growth inside of a Roth IRA? Zero. You don't pay any. But when you pass away, how much do your kids pay on the Roth IRA balance that's still left? Well, guys, that's also zero. They don't pay anything on that. So total taxes paid here, $125,000. So Please note, this is a hypothetical example. It does not consider every single product, feature, benefit, and requirements of an IRA or Roth IRA, and should not be deemed a representation of past or future results, and there's no guarantee of return of future performance. I'm not the micro machine guy. I can't do this as fast as he does. Your tax bracket may be lower or higher in retirement, unlike this hypothetical example, but you get the idea, right? Potential decision right here is $338,000 or $125,000. See, here's the issue that I find though. Most people don't want to rip off the Band-Aid. I mean, if you talk to a CPA, it's all about how much money can I save you on taxes this year? The problem with that is that could be a $213,000 tax bill over the life of your retirement. So most people don't want to pay taxes until they absolutely have to. In some cases, though, it may actually be beneficial to pay those taxes earlier rather than later, just like in this scenario here. Now, so here's the bonus tip for those that are already retired. Without earned income, most people know that you cannot contribute to a traditional IRA or a Roth IRA in retirement. But a lot of folks already retired forget that there's one specific account that they actually still could contribute money to and get a deduction. Not only would they get a deduction, any growth is tax deferred, and any distributions are tax-free if they're used to pay for medical expenses. What is this account? It's an HSA. So guys, an HSA, you can still contribute to this and get those tax savings, at least as long as you're not 65, right? And on Medicare. So once you're on Medicare, you can no longer do this. But if for those that retire early, you can actually still contribute to an HSA if you're on a high deductible health plan, and it can give you that triple tax advantage. That's the only thing that you get a deduction when it goes in. It's all tax-free growth and it's tax-free distributions. That's it, guys. So that is the big caveat, though. You can't be on Medicare already. It's for those that retire early and still want to be able to put some money into some tax savings areas that can be used for medical expenses down the road and even premiums down the road as well. They can be used to pay for those. So that's it, guys. Go ahead and smash that subscribe button and hit the notification bell so you can get updated every time we have new content like this. And we're always trying to empower you to live the retirement you deserve. So thank you, guys. Tune in the same time next week.